Good morning, traders. Welcome back after the Easter break for those who had the chance to have a little bit of a break. And to the others, welcome back to the Flow Show. We write Tuesday, 2nd of April, 2024, and we started the Q2 of 2024, in which I expect that we are going to have quite a bit of activity on all sorts of fronts. So it's good to get the engines fired up, and let's see what's going to happen in this Q2. I especially expect that towards the latter half of Q2 we are going to have a lot of movement in the market. But in the meantime, things are moving, so let's see what happened over this Easter weekend and over the turn of the quarter. So let's start in China, as we usually do. We had on Sunday, we had the manufacturing PMIs coming out, sticking their head above 50 again, also confirming the services doing a little bit better. Not that it specifically underpinned the Chinese yuan. We had a little bit of a setback on the dollar CNH, for instance, dollar CNY as well. But that's mainly because that the PBOC is still fixing stubbornly high for the Chinese yuan. That is low in dollar China. They are still in the 709s, where the market, even the local market, is trading rather around 723, 724. And as a matter of fact, because we know they have this band around the fixing in which the CNY can fluctuate, and we are at the bottom end of the band, the top end of the dollar CNY, and they sent out the Chinese banks again to sell dollars on the top end of the band. So they're still not letting this market go, but despite also having factory data coming out, not too bad, the market is still not buying the Chinese revival, and we're still trading dollar China above 726. To have a side note here in regarding the nearshoring, friendshoring situation. There is the AI and other tech giants in the States are turning to Mexico to make AI gear, and they are spurning China. So we are still in this story of the nearshoring, friendshoring, still there, and I think that also is one of the factors why the Chinese yuan is not yet, or not getting any support so far. So that for the Chinese situation right now. Then moving over to Japan, we had the Tenkan coming in yesterday. It was a bit of a mixed bag. Yeah, the big manufacturers, the large manufacturers here, we're seeing those numbers remaining sort of on a better trend. It's coming in a little bit on the higher numbers, but then if you look at the small manufacturers, where Kishida is wanting to push for improvements, they are still, for the better part, hanging around levels where they were before, and having really difficulties to start to show same numbers as the large ones, who of course have much a bigger international involvement there than really the small local ones. So this bit, I'd call it as a bit of a mixed bag there. In the meantime, we are now getting daily comments from Suzuki, especially saying that they are seeing some speculative moves in this market, that the market should be moving, of course, in line with fundamentals. They think that it's not really moving in line with fundamentals, and as a result of that, the dollar yen is stuck, even where the rest of the dollars are now making a bit of headway. The yen is doing a little bit better on selected crosses. But they do seem still to be nervous about this 152 level. Now, I've been talking about this level over the various shows. It's rare that Japanese officials are really putting a red line at a level, but I have seen this in the past. Okay, there's been levels mostly to the downside because they intervening on the top side is since 2022 relatively fresh for them as well. Um, but it's kind of rare to just put a level, stick a level on there and then not letting it go. So I do think there's much more going on at 152 than just the officials. I do think that there's big barriers out there. We don't see too many reports about them, but we know that those what is it, CFTC or whatever numbers, they don't show the whole market, and there could be some whales in the background having like very big barriers there at 152, because the fact that we went up to 92, 94, 96, 92, and then not being able to go to print even 152, if it would really be only exporters or Japanese officials, we may have traded 152 already. So I do think that there's still much more going on there at 152. Okay, so but that makes it also a very dangerous kind of situation if ever we trade at 152, because various things can happen. You can just fly through, do a massive run of stops, and then your 152 becomes bid, and we race straight away to 153s, 154s, which in turn then, in my opinion, will increase dramatically the intervention risk if it's a speedy move. Barriers can also be traded, or can also have a result completely different, is that we print 152, 10, 20 very quickly and then completely reverse because the barriers are not there anymore. The market is a lot cleaner, and it could result in actually the aggressors of the barrier being very long dollar yen and all of a sudden needing to sell all those dollars out, and we can have a pretty big setback as well. So that in the case of those barriers, there's a few possibilities there. I do think though that a lot of people in the market are now leaning against this 152 because it seems like a brick wall, but I'd be very careful because I do suspect that there's big stop losses above this 152 now as well in the dollar yen. So be warned, take care, be a little bit conservative, I'd say, with your positions, because it can go quite hard if this 152 would give away one day or another. All right, then, moving on. We had the, let's move on to today. Then we've had the RBA minutes. I'll leave the US block for the for a little bit later. Okay, we've had the RBA minutes overnight. I'd say relatively neutral, but then there was this article, or this new project also that they came up with, is that the are to switch to a new system for monetary policy implementation. And they say Kent was the one who said that ample reserves should stay in place, and that those ample reserves, that shift should have no implication for monetary policy. But we know that that is not really the case. It's going to have, whatever happens, an implication. Ample reserves can mean two things, is that they, after screwing back on the bond buying, they go back to pre-pandemic levels, but it can also mean that those ample reserves mean that they will also ask the banking system to contribute to this kind of reserve system. I mean, very simply said, they could ask the banks to also have ample reserves, in which in turn is actually a little hawkish for the rates. And I'm not sure whether it's just like Euro, Aussie, or other Aussie crosses at play, but we've seen actually the Aussie tick up smalls this morning, and I think that is perhaps the reason why, because we can read it as both ways for the system. First reaction could be that, oh, if they keep ample reserves, that means that the RBA is going to remain relatively loose with their policy, but it could also mean that they will ask the banks to contribute and themselves have ample reserves as well. So I'd say it's a little uncertain, in my opinion at least, a little uncertain what it really means for the Australian dollar, and we've seen the Aussie dollar picking up smalls this morning as well. Right, then moving on to the PMIs. All right, so we've had yesterday, and I'm going already to look at the US ones as well. We had the Canadian manufacturing PMI as expected. Final US S&P manufacturing PMI coming in slightly lower, but still comfortably above the 50 line. Then we had the ISM manufacturing PMI coming up, and that crept back above the 50 line. Okay, yes, the employment index is still sub 50, but it's a bit higher than the prior ones. The prices are rising again, okay, and the new orders are getting back above 50 as well. So that caused the dollar demand, the dollar demand yesterday in a market where there was not really a lot other happening than that. That caused yesterday the demand, and then it was also helped by the Atlanta Fed GDP. Now we are going to be to have another 12 or 15 revisions before the final number comes out there. Okay, so don't hang your head on to those numbers. But where we had small downward revisions so far, they revised it up. So we saw the dollar coming in better bit towards the latter. Or the after the US noon, okay, yesterday. Moving over into the European PMIs. So we had, they're all showing a little green compared to the preliminary data. But then if you look at they are a bit mixed if you look at them versus the prior data, okay? So the Spain came out a little bit better around the prior number. Italy, small beat, that creeps back above 50. And but if you look at the French, they are still below the prior one. If you look at the German one, they are still below the prior one. And if you look at the pan-European one here below here, still below the prior one as well, okay? So shoots, yes, but we don't know how green those shoots are yet, okay? It's not while it's green up here that it's really a number to buy massively euros on. And then if you look at the German regional states, they have come up with their March CPI data, and there was absolutely no exception here. I think they all come in lower on the year-on-year compared to the prior ones. So that is also weighing a little bit on this European picture regarding the inflation over here or over there, I should say. I'm not in Euro on the mainland. I'm in Europe, but I'm in the UK. But it still weighs on the picture here. So we've seen the European crosses, barring one exception, which I will talk about in a minute. Barring one exception, we're seeing the Euro crosses a little bit on the defensive as well this morning. Okay. Right then, moving on to what's happening in the UK. We've had here the shop price index coming off quite a bit, and we're also seeing a little bit of the house price index coming under a little bit of downward pressure, which is good news for the people on the street. A little bit less pushy for inflation, shall we say? But then we had these countered by decent credit numbers here, quite decent credit numbers, and also the manufacturing PMI sticking its head back above the 59 as well in the UK. So, as I said on Twitter or on X, formerly known as Twitter, I say go good Team GB. So those are actually pretty okay numbers, even if you take into account those housing data. If you take the whole lot into account, it's actually not too bad a series of data for the consumer as well. Yeah, some people were already saying, oh, maybe due to these lower prices, the UK may cut before the ECB or the Fed. I still want to see that, but I find this series of data not to be too bad on a whole, you know? I mean, it's looking pretty okay, those UK data. And then moving over to Switzerland, we've seen a little better, the PMI, a little better than the last one, but this market is still in the mood to sell Swiss franc. And I'm going to have a look at the charts in a bit. The Swiss franc got a little knock on the head after yesterday's US data, and in the morning as well. We've seen Swiss crosses moving higher. We've seen also the dollar Swiss moving again a bit higher, which is still encouraging for those in our chat room, including myself being short Swiss franc. It's still looking pretty okay at the start of this Q2. What else? Okay, last thing regarding in the Eurozone is that we had a couple of comments over the weekend, and I'm just going to come back to two of them. The Greek member of the ECB, Stournara, said that he's a dove, okay? So we have to put everything in context. He's a dove, and he could see up to 4 cuts, 25 BP cuts this year, okay? That is possible because he says inflation is moving the right way. He's actually getting it right. If you look at the German inflation data today, he says the inflation is moving the right way. So there's very little standing in the way of 4 cuts this year. And then we have our friend Holtzman, which until a few weeks back was the Uber hawk of the ECB members, and he says that ECB could actually cut before the Fed. That is some statement from an Uber hawk. Now, this being said, that could still mean only June, because in June we will have the ECB will meet before the Federal Reserve. Okay, we've got the ECB on the 6th and the Fed on the 12th. But like somewhere psychologically coming from an Uber hawk like he used to be, it's a headline. So I'd say watch more of those comments if more of those hawks are slipping into a less hawkish, even neutral territory, which he now seems to find himself in. All right, so that is something to bear in mind, I'd say. Now, back over to the US, and I will go back to all the way to Friday, okay? Because we didn't have a flow show on Friday nor yesterday, so I think it's worth taking a small look back for two reasons. First of all, we had those PCE data out on Friday, which were relatively neutral, but we saw the price index tick up just slightly on the year-on-year. We had personal income coming in a little bit lower, but that was counterbalanced by a higher personal spending. So sticky is still the word there, especially that the prior number, as you can see here, was revised from 2.8 to 2.9, again, the price index. So it's still sticky. And then we had the powwow, okay? And there I want to come back onto Powell, because mainly he spent more than half an hour saying that things are still moving into the right direction, not really fighting back against what some people in the market call the pivot. I wouldn't call that a pivot, but just looking at the data and adapting to what the data are telling them. So on that front, I thought it was relatively neutral. It didn't give the market though the famous June line. It didn't confirm, and that's what I've been saying for actually quite a long time, is that, and that's the interesting bit in my opinion, especially looking at what's happening this week. He picked up the dual mandate line again, okay? And I've been saying for a good while now that I think that side, the employment side of their mandate, is going to get more and more important again. And he's finally come around and said that this is now that what they are going to watch. And looking at what we are going to have for the rest of this week, this is going to be, in my opinion, mega important, because we are in an employment week from now on. It starts this afternoon with the job openings. It's been a bit shaky, although the numbers have been they look on the surface to be hang on a minute. They look on the surface to be relatively stable, but the market is really looking at whether those numbers are going to continue to come off to try and guess what the Fed is going to do. But I'd argue those are probably not the most important ones coming up. We will have the tomorrow. It really starts right. Because we will have also the ISM services, which are bigger than the manufacturing, and we will have a very close look on what the employment index is telling us there. And then we have the ADP, which has been relatively stable. It's usually a very volatile number, but it's been okay, stable right now in the past few months. So that is one that is going to hit the wires tomorrow as well. Then what do we have on Thursday? Yes, we have the weekly claims coming out. And then, of course, on Friday, it's NFP day. So thinking about this dual mandate, if we accept that the inflation is going their way, but a bit slower. Also, I remind you that they said they don't need to hit 2% to start moving rates also. But this week we are going to concentrate on the employment, all right? So we are expecting 205, just to name the main number. I'd also say watch this one very closely, which is going to be impacted by the participation rate, if we are starting to hit 4% or not. Okay, still 4% is not alarming, but we know how the market will react on a change of big figure. So this may be initially a little bit of a mover. But I'd say and of course we are going to look at the earnings as well. But the earnings is that inflation bit, and if I'm right in saying that the actual whole labor market is going to have more and more importance from now, we will have to look also at the headline data and all the details in those employment reports. So I think it's going to be a very important week for the dollar, and also for understanding where the Fed is at, because as we have been banging on about, we are all data dependent. They are as well. So if that side of their dual mandate starts to move, then we are going to have to move ourselves too. If it remains, and let's call that sticky as well, which is a positive one in this case. If it remains a sticky high number and they continue to print decent numbers on their employment reports over in the States, then I really see this week being a pretty decent dollar week, and I think the dollar could actually advance quite a bit more if this part of their dual mandate stays positive. Okay, so this is going to be an important week for what I'm concerned on the dollar. All right. Okay. Let's move over to what most of you are always waiting for, and that's the charts. If you guys have any questions, just fire away. I'm going to try to not keep you too long today, but it's important to look at what's happening here. So this is what's been going on the interest rate differentials front. Okay, we have seen the US yields really ticking up, and that's created a bit of a a widening again in the European versus US spreads on the short end, because as Mark was right in saying this morning, the bunds have not really followed the whole move that the US yields did. I think the US yields were supported by those data that we saw, and also by Powell. But also, let's not forget that we were over the turn of the first quarter, and that may be also just a move to start Q2, where the investors have to rebalance, reinvest in some assets. So that is something that could potentially be reversed over the course of the week, or accentuated if the numbers are really good. Okay, so let's take a look at what's happening in the short and then the more medium term. So, and I'm keeping those lines on here because I think it's relatively important. So these are where the dots still are at right now. Okay, so they are still showing 3 cuts, although further down the line they're showing perhaps 1 cut less, but the concentration around 3 cuts was still there. And if you look at the short end, which is the 2-year, which is the closest one to what the Fed may be doing, I think this just a reminder where we are at in pricing cuts. This could be an interesting one. So every 12.5 BPs, it's half a cut more or less. Okay, I should put the more cuts in here as well. But we were down here at fully pricing in nearly 4 cuts, and here even more at the start of January. But we are now back in between 3 and 2.5 cuts. So the market is now going to wait for those data to confirm. Okay. And if you look at on the 10 years, we're also at important levels here, and that's this 435, call it 435, 440 zone on the US 10s. And that as well is going to be an important one to monitor where we are going to close the week. Okay. So you got the 420 on the one hand, and then you've got this 435, 440 on the top end. I'm going to say if this global package of employment data come in positive once more, defying the laws of gravity, because everybody is always waiting for, oh, this is going, are we finally going to see some weaker data in the labor market? Well, so far we have to just wait because we didn't have any of it yet. If they print a strong number again, I am going to say that we are going to fly through here. And then we can indeed get back to that, possibly that 460 level, what Dale has been talking about a good number of times on the F.A.C.E show. Until it happens, respect it. Okay, until it happens, we really have to respect those levels. The 420, yeah. And 420 and a couple of BPs for the algos, okay? But it's the 420 where we are at the end of the week, above or below, and here 435, 440, above or below on the US 10s, okay? Currencies. Euro dollar. Euro dollar is coming back into this support zone here. We've seen those lows early February. We've seen those lows as well in early December, from where we started the last leg up in the euro dollar. We're back to those levels. Okay, we went like a little bit below here, and we went below here in the middle of February, and then we had towards the end of Feb, and then into early March we had this rally. Now we are back here. Okay, the one that I was drawing here as well is this little bit of a triangle which has broken, because it gives us a quite nice resistance zone now up in the high 107s towards the 108, 108.05 area. This is going to be a level, I think, which if the US data are not too bad, may come in as a resistance right now. But I would, sorry, I would look at those levels coming up here. And we stopped on it again this morning, right? We went into the 107.20s, and we're starting to bounce again, all right? 107.20s, this one is probably watered down a bit now, but 106.95 figure is the next 106.95 figure, if we start to break below there, then it opens up a little bit of a gap. Not a gap, but and not a black hole either. But I think then we can do actually another big figure. I'm positioned that way via an option. I think it's very possible. I do think that globally the numbers between the US and Euroland are still favoring the US, but I prefer not to have too much cash, although I had a little bit in it as a side play. But I prefer not to have too much cash because we are in front of such a big US employment triptych, like 3 days again of US employment data to hit the wires, even 4 days, right? If you count the jolts in it today as well. But if we start to break 106.95 figure, I think it probably may be we're going to do another big figure, and why not even get closer to those prior lows? All right. Moving on to the cable. Cable, I see a slightly different picture, although it's really moving in line with the euro dollar, because the euro sterling again, this euro sterling is really it's a real magnet. This 85.5, and we're still turning, and we're again turning around there as well. But in cable, we could argue that we could argue we have broken here, and then we went quite a bit lower as well. But we are on support. We came to that support here around 125.40, and I would say respect it. There is, when you are ahead of those of such an important slew of data out of the US, it's always important to respect it. And I do think that the market, the shorts in the cable have taken some off possibly this morning, ahead of this data dump that we're going to have in the next 4 days, because I don't think there's much coming out really out of the UK. So I would say respect it. There's 3 levels here that I would say respect it. So there's the 125.40, which is support trend line. There's 125 and 125 the figure, the prior low here. Those 125 the figure is going to be a bit psychological, okay? I know there's this 124.60 also below here, but I think 125 is going to be also psychological enough. If we get down there, it is possible that on strong US data we're going to visit Dale's 124 or even 123.65 at one stage. But in the meantime, and personally, I'm not really a fan of being short sterling as such. I'd rather be short euro dollar, for instance, or be long dollar Swiss, for instance, than short cable, just because I still think there's a little more positiveness in sterling than in stuff like the euro or the Swiss, for instance. So this is not one that is going to be really on the front of my radar, but it is an important level enough to look at. Okay, Aussie. Aussie has broken the triangle, whether it's a short-term one or the longer-term one, and again it's broken where this famous box is, right around 65.20.25. But then we came into this low here, these lows here, these lows here, and we're starting to bounce again. I think the 64.80 is important enough now to look at on the downside. All right, I tried to accompany this move, but then I gave up this morning because I wasn't really sure what to read on those RBA reports. And yeah, I'm really going to wait for 64.80 to give way, or perhaps give it a try again. We're not too far. It's a pretty tight range here, 65.25, 64.80. And it's going to be from here on, it's going to be US driven, I guess. So trade the dollar on the Aussie dollar, I'd say. But be careful if we start to break back above 65.40, because then I guess some shorts could do a runner, and we could find ourselves pretty quickly back up to 66 again. for the time being. Technically, still looking a bit weak, but respect this number. Kiwi is about the same. We've broken here. It's trading down, but there's a bit going on here around 59.5. We had a look below to this level here, 59.40. It's holding. I only got very tiny in it right now. I'd love to see a confirmation sub 59. 59 is going to be a pretty decent number. It's basically the big figures, 59 to 60. That's going to be your playground right now. If the numbers are really bad in the States, but they will have to be bad to get a move back up to 60 and a quarter or those high 60s. That means that something's wrong with the dollar, and then we have to be careful on all dollar pairs. Okay. Swissy. Yeah, Euro Swiss, despite the European numbers being a little bit average, is still ticking higher and is still holding that support line here. I don't know if there's many people watching the cloud in Euro Swiss, but since it's turned, actually, it's been a really decent support area each time it came at or inside the cloud. It's not closing below, so maybe you can keep that one as a bit of a guide as well. That's coming in around 97.10. 97.10 is your support on the Euro Swiss today. I've got only very tiny in it because I'm only a half believer of the euro right now. Sterling Swiss really, and if you go on to the lower time frame, look at this. This is a beautiful channel, right? And if not the first one, the second one is acting as a bit of a safety net here, but it's been really trading nicely inside this channel since the start of 2024. It's been building, and it's really holding nicely inside. We had a few looks below, but never put any of the more serious fibs in danger. We're back at a bit of a crossroad here, and I have to get back onto the more bit longer term here. We're back on the a bit of a crossroad here. You see this one here, this trend line coming down, this trend line from the October, where the year end really started. Yeah, we had the acceleration here over that high. We're at a bit of a crossroad here again. It would be nice if we can clear that once and for all, because we had like 1, 2, 3, 4 attempts to get above and failed a couple of times. Would be nice, but it's encouraging as well to come back to the level. Would be nice if we can get through it and then see what happens up in the high 115s on this one. It's going to be an interesting zone here as well. But I do think looking at Swiss data, looking at the relative silence of the S&P, they haven't told us that they don't like this move. So I still think Thursday, Thursday CPI in Switzerland, all right? Keep it in mind. If we show more weaker data, it could be your clincher to really break those levels. In the meantime, patience and observe the positivity. Stay positive. Dollar Swiss is on its level as well, looking a bit similar to all the Swiss pairs, right? But it's on its level as well, and I think this is your prior high here, 90.70. Trend line here, 90.70. We are slightly above. Would be nice if we get decent US data, but always prepared, of course, for anything. But if we really get no dramas out of the US, this is probably going to push up into the 92s from where the year end started last year, and then we reassess. I think then we reassess. By the time we get there, that's another 1.5% or so. Then it's probably time to reassess a little bit. I'm patiently waiting for that to happen, to take a bit of profit and then see where we are, take a look around all the data where we are. But I know the longer term picture, and Ben in our room was showing the longer term pictures. They're actually this longer term picture is actually arguing for a move back more up into this zone. 98 up to even parity. It's all possible, you know, if the that's what trends are. If the US data remains strong, if the Swiss data show some more sluggishness, it's all possible. That's a trend for you there. We have done it on the way down. In a year's time, we can do it on the way up as well. You know, that's how a market functions. But one step at the time. Okay, one step at a time. So that is yeah, dollar CNH, not too much to talk about. Still beat this one. This Mexican peso is still an 11% currency, and it's still behaving pretty well. Yeah, we have like those small upticks, but this is one where I'm still having a little bit in from this zone here. It's a small position, but it's nice because I'm getting paid to keep it. So. That's always nice. I think decision time may be also closing in because this trend line here comes from 2013, had a bit of extension level 1760s as well. So I may decide to take it back or at least most of it if we see that zone. Okay, last one to look at because people are asking and nervous about what's happening on the metals. I know there's been some there was a bit of a target around here as well, but I had it a bit lower around 2055. Where are we now? Yeah, we are turning around that level. And we were talking about it in the room. It does seem like with the initiated, I'm just hovering around above the BTC, the Bitcoin little tag there. I've got the impression there's quite a bit going on in Bitcoin versus gold, and that's very much an cross for initiated people. But yesterday, when gold was losing steam, Bitcoin was going up, and now we have a rejection in Bitcoin, but gold is going up again. We've seen this before, right? These rebalancings in gold versus Bitcoin. But for those trying to call tops in gold, let me go over to the daily. Well, I'd say we still cannot really call it. This prior top here, 22 and a quarter, 22.20. That's your real first support, in my opinion. All right, that's your real first support, and for as long as that holds, we are in those kind of S&P scenarios that we were showing before as well. Like you do a step, you come back, you overshoot, you come back onto the step, then you do the next step, you come back onto the level, and then you do the next step. Well, we haven't really reversed yet. I would start to possibly call a reversal on gold when we start to break back below 22.20, not before. It's just my view on this one. Yeah, we hit targets, but then we hit targets so often in stuff, and it just doesn't stop. Okay, silver is turning around that level here. It's continuously turning around this double triangle. Okay. When people talk about trading dollars and metals, all right, I just want to close on this one. Silver compared to gold, but you know what I'm going to say, that can do actually with better data, a better economic data. Whereas gold, if you get worse economic data, it could be seen as a safe haven when people want to jump into more physical. Here, this one is a bit of a mix, but this could do with better economic data, actually, or better EV data, or better Chinese data, for instance. If China starts to improve, actually, silver could actually go a lot faster higher than gold, for instance. I'm not adding anything, but I will have a very close look on on that U.S. labor report because it could have like an indirect impact. Like for instance, if the numbers are slowing down but not really falling out of bed, I think this could actually help silver as well. In the meantime, respect these broader things um, and those prior highs here around 26 as well. And I'll leave it there for today, guys. thanks very much for joining me today. Thanks very much for coming to the Flow Show. Trade safely, and we speak again tomorrow.